Happy Monday to you, Greg Sher. And look who we have here. We have landed a whale of a celebrity in Chris Whalen. What's up, my friend?
Well, what's up is Thursday. We're getting ready for the snowstorm and playoff football, of course. And
I know.
I'm in New York City, hanging at the Lotus Club. We're going to have Julia LaRoche and Julie Hyman from Yahoo for dinner tonight with Jim Rickards and talk about gold. So
Gold.
Better than that. Yeah,
hey, well, that's
look,
it's high. Gold is not Bitcoin, Chris. Gold.
No, I'm a traditionalist. I like hard assets, real estate, gold, canned goods, 12 gauge rounds.
Oh, so if there's some kind of big problem, you're good for a couple of years. Then I'm coming over to your place.
I'm going to be up in Maine in Grand Lake Stream hanging out with my buddies, 100 miles from the Canadian border.
So you're well known, American investment banker, financial analyst, author, commentator on banking, credit markets, financial policy. You are the first person I have ever had who has testified before Congress, the SEC, FDIC, probably many, many more people. You're the chairman of Whalen Global Advisors, very highly respected voice in the housing industry. And let's jump right in, shall we?
Yes, sir.
So Davos, there was a lot of anticipation. Let's start there, that the president would come out with some very robust policy reform when it comes to housing. He seemed to repeat a lot of the things that we already know about. I know that apparently the flight to Davos had to return over the Atlantic Ocean. He looked like, he was a little bit tired, so maybe the timing wasn't right. What did you think of that? And do you expect that we're going to see some kind of sizable announcement here coming up soon beyond the idea of 401ks being used for down payments?
I think most of the policy options that any administration has, and this goes for the Trump administration too, are demand side. So we can do things to help grow demand for housing. But the big issue really with affordability is the price of homes. That's why, we've seen mortgage rates go down a point in the past year. And what you're seeing is more refi activity, but not so much purchase activity. And that's why they're talking about 401ks. They figured, well, we give people additional firepower in terms of down payments. We've raised the conforming limit, therefore we get more business. The trouble with that is it'll just push up prices. You have more bidders for a limited number of homes. And it's the supply side really that I think is still constraining us, Greg.
So I shared that I thought that there were two things that could really bring affordability back into focus. One of them was very popular, lower rates. Everybody applauds that. The other idea I had, and this was, I think, 6 months ago, I did a post on LinkedIn saying that we need prices to decrease. We need them to go down. I don't know. I did the math at that time, 15 or 20%, along with rates lowering, to really get this thing back where we're traditionally accustomed to it being. And then that will turn the spigots back on for first-time homebuyers getting in. I've read and heard a lot of the stuff that you've done, and you concur with that. Can you tell us how you arrived at that very unpopular thesis that we need house values to go down something more than 2 or 5%? That won't do the trick.
Well, you heard the president. The president came right out and said he is not going to break housing. He's not going to force prices down and therefore cause people who bought a home in the last 5 years to lose money or end up underwater. We're already seeing the number of homes that are underwater in the FHA market, for example, rise pretty dramatically. But ultimately, look, the Fed used low interest rates during COVID to fix an immediate problem. The Treasury market had stopped functioning. We dropped rates to zero, and voila, we had a bull market in housing. We had half the mortgages in the country refinanced. I have a 3, by the way, that I got in February of 21.
So, boomers, baby, boomers. Let's go.
Well, yeah, boomer who works very closely with a dear man named Stan Middleman at Freedom. And I said, don't you dare price this mortgage until the day we closed. I wanted to get it below 3. But I was a year late. Let's be fair. I have friends out there with 2.5s that are still owned by Bank of America. Okay, what's wrong with this picture?
Yeah,
they should have sold that loan and bought T-bills. So anyway, the point is that I think you're going to see an uptick in activity this year and next. And again, this follows the roadmap that Stan gave me in the biography I published of him in 2024. And then we have a housing price reset about what you're talking about, 15 to 20%, maybe a little more. Maybe we get down to 22 or 21 levels. We won't stay there for long, but I think it's an opportunity for people who want to get into this market. So
Well,
you'll have
that's interesting. That,
this.
that's that's severe. That's a big one. That's a big drop. So, like, I read your book, great with Stan, seeing around corners, and he talks about misery on the eights. That
Yes.
things seem to happen. 2008, 2018, 19, COVID-ish. Yeah, and now we're looking at 2028. So that's pretty dramatic. What
Well,
will
it is,
be?
but Greg, we haven't had a correction since housing prices bottomed in 2012. I was working at Carrington and they were clearing out the foreclosure backlog. And since then, home prices have basically gone straight up. You've had a number of reasons why, but the Fed is the big reason. And, I have always said that it's a mistake for Donald Trump to attack Jay Powell because we've got enough reasons to be critical of Jay Powell. We should have just let him retire quietly. He did not do a good job on QE. They did too much too long, and home prices went up more. Very simple math, right? So, I think to fix this problem is difficult because to have the market sustain a down price period like that, it's going to cause issues. And it will certainly get the price of default for 1 to 4 family mortgages back to normal. You know what it is today for bank-owned paper? It's zero because the value of the collateral is so high, you can't lose money on them. But for lower income families, FHA, obviously, it's up around 11. Serious delinquencies around 4.
Well, how
So
concerned should we be with the trend with FHA loans?
I would be concerned. It's a slow, steady process where the forbearance that we had in place over the last 5 years is going away. We're back to the old pre-COVID rule book and waterfalls in terms of loss resolution. And so, you get one shot at a mod. If you don't reperform on the mod so that they can sell that loan back into a pool, they're going to take you to foreclosure or some kind of resolution. That's it.
Mm. So the CHLA, Community Home Lenders of America, helped to push through bond buying to the tune of about $200 billion between now and the end of the year. You don't like that? Why?
The GSEs are not really set up to do this, to run a hedge fund. We saw what happened with Chairman Powell at the Fed. He's lost hundreds of billions of dollars. And it's not going to have much impact because the GSEs have to hedge. They don't have any capital. So they cannot afford to take a loss on a $200 billion position in mortgage-backed securities, which, as you know, Greg, can be a little bit difficult to manage. We have issues like convexity. We have issues like the long end of the market backing up every time the Treasury does a refunding. So even though we're all talking about lower rates, lower short-term rates, Treasury just raised $700 billion. And oh my gosh, the 10-year was back to 4.25. That kind of move could bury the GSEs. And plus, they don't have the cash anyway. They're going to have to go out and borrow the cash.
Yeah, so a couple things on that. I mean, rates did go down. It was reactive, but I think you'd have to, so I ran the analysis on just our pipeline the next day, and we were able to deliver an eighth better rate to, I think it was 100 borrowers or 120 borrowers, and that translated into about $1.3 million in savings over 30 years for that pool of borrowers. We're just one lender, so I mean, I think in that manner, it short-term work. Now the fact that the bond is back up, Greenland, all of that, talk is making the market very unsettled, right? Hopefully now we're back at some kind of a norm.
It's a day-to-day thing.
Yeah,
you have to price loans. I always tell people on Wall Street, lenders price loans. You have to make a decision every morning. What am I going to do with my product? And how aggressive do I want to be getting loans versus keeping the MSR? That's the way I was taught. On the other hand, you've got to sell that loan 30 days later. And you've got to try and figure out where you're going to be, how much hedge to put on, et cetera, et cetera. So what we've seen in mortgages all year is they would do better, they would come in and then they would retreat. and I sit with 3 of our TBA traders in New York. This has been the story all year long. Then you add Donald Trump and Greenland and these other issues that affect the long end, not the short end so much. The other thing to keep in mind, and I think your audience will appreciate this, is that 2s to 10s, the 2-year versus the 10-year, is flattening out now. So we are starting to see a kind of an interesting evolution of the market that, tells me that if the Fed drop rates again, say a quarter point next month, I'm not sure how much bang we would get out of the longer end of the curve. That's kind of where we are, I think.
Interesting. And so this new Fed chair that's going to be coming out here any day.
Imagine.
So do you, obviously it's a long process. There've been a handful of candidates. Doesn't seem at this time, and we're recording this on Thursday. We'll play it on Monday. So fingers crossed there's not someone named by then. Although if it happens, it happens. Kevin Warsh is a name we've heard a lot. Doesn't seem like Bessent wants the job. Do you have any faith that this appointee will be independent, and they won't be working hand in hand with the administration on rate policy?
I think when Fed chairmen are confirmed by the Senate, a magical process occurs, and they walk into the front door of the Fed, and they become independent. It's the way it's always been. I remember the story about William McChesney Martin, who came in after the big battle between Harry Truman and Mariner Eccles after World War II. The Fed got their independence back in 1951. Mariner Eccles stayed on the board for a few months to support the chairman, Tom McCabe. I think Powell will stay on the board, by the way, through 28.
Well, I think look, that's a great point. I want to talk about that because the way that he behaved the last 4 or 5 months, some of the comments he's made, the length to which he's gone to make a statement, like, and I'll paraphrase now because I don't remember the exact words, although I did post about it. Basically he was like, the market was behaving in this way that it looked like they were making an assumption there would be a cut in December. And he was basically like, oh no, don't count on that. Like, he really seemed to me to go outside of the box there to like almost take a swing. And what happened the next day? The bond market went up, rates went up.
Yep.
He's human. How personal do you think that this whole thing has been for him? If you had to weigh in on your opinion.
I think it's very personal. I've spoken about this extensively in the media. I worked for Paul Volcker and Jerry Corrigan at the Fed of New York. You don't treat these people this way. The Fed is a special place. They never say anything in public. They don't want to. And so if you're president, you're not happy with the chairman who you appointed, by the way, you sit down with him over dinner, you have a nice chat. You say, look, I'm not going to reappoint you. I have some issues with some of the things you've done. I'm going to pick a good candidate. And that's it. You don't send Bill Pulte after him, because ultimately all of the public criticism of Powell has just made him want to stay to protect the temple. And let me go on, because your question, earlier is right to the point, which is that what happens when we get Kevin Warsh or maybe this fellow from BlackRock? Well, I'm sure both of them are fine. Both of them will be quote unquote independent, but Fed chairmen work by consensus. If the Fed chairman doesn't have a majority for a rate cut, they're not going to ask for a vote, because when Fed chairmen start losing votes, they usually resign. That's what happens. So I think that the new chairman, whoever it is, and I think it'll be Kevin Warsh, simply because you need somebody who's been in the building before. To have a brand new chairman, I think, would be a recipe for disaster. And, they'll have to do the right thing, if for no other reason than the current FOMC with the new voting members is more hawkish than what we had last year.
Yeah.
You probably don't have a majority for a rate cut now. So the new chairman's going to have to walk into that room, prove to the other governors and the staff that they're going to protect the institution, and then they can start to work on a consensus for further rate cuts, maybe one this year. I think that's doable.
So if you're in the mortgage business, like we are, like I am, like my listeners are, a lot of them, meaning in the manufacturing process of loans in the day-to-day, we think about a lot of things in this business. We think about what Varun Krishna is doing at Rocket, and this idea of the flywheel, and originating and servicing, becoming one, and teaming up to offer all of these ancillary services with the thought that the consumer is going to want to transact inside of one financial ecosystem and be okay with that. And that's a real fear that the way we do business today, unless we adopt some of those things and build out those verticals, we could be living on borrowed time. Your opinion?
I think you said it very well. First off, Greg, the operative model here is J.P. Morgan. After the great financial crisis, Jamie Dimon decided to stay in mortgages, even though Wells and the others, Bank of America, were getting out. They stayed in correspondent, but they went up market. They said, we only want big, really high quality loans and no FHA. So that was kind of the moat, the castle with a moat around it. He has the servicer. He owns $10 billion in MSRs. He's now the biggest dog in warehouse lending, by the way, with the team from Flagstar. So next you have Rocket. Rocket buys Cooper. Rocket buys a realtor. And again, you have created not just an ecosystem, but a walled castle with a big moat around it where you can protect those customers you have by having good recapture, having other things to offer them, because you can call them. That's the most important valuation component of a mortgage servicing right, is the fact that you have a relationship with the customer that allows you to contact them. And if you can retain 30 or 40% of those loans when they prepay, yeehaw, you're in great shape. But I think you're right. That is the model, and everybody else is going to be a broker. You've seen Matashiba at United Wholesale. He also, I think, is tuning his business model to retain more MSR. Maybe he's got to turn down the gas in terms of pricing, and he's going into servicing. I'm not sure that's a good idea, but I think, he's looking at the other models and he's saying, I've got to be in servicing. I've got to control this internally. He's got a real engine when it comes to creating new assets, no question, right? And the issue, I think, is, can he do that profitably over the long term?
Yeah. So
again, I think, and PennyMac is the same, by the way.
So questioning whether this is a good moment for servicing. Let me just touch on that real quickly, because some people are probably like, well, why not? Is that because rates are expected to come down and you don't want to catch a falling knife, or is it something else?
It comes down to business efficiency. I've worked with the guys at Cooper for years. I focus mostly on MSRs, and they have managed to tune that machine so that they are the low-cost provider in servicing. They're also very big. You need scale.
Got it.
You don't have $500 billion in the house. I don't think you're big enough, Greg.
All right. So what future do you think banks are going to have? When I say future, I'm talking about more near term than anything under this anti-regulatory framework of this administration. What role do you see banks having when it comes to getting back into the mortgage game? And is that a threat to IMBs?
I'm not sure it is. The drop in the percentage of bank assets that are invested in mortgage-backed securities and 1-to-4s and mortgage servicing rights is long. It goes back 40 years. Accounting often masked just how dominant banks were, because many banks would have originated MSRs that they booked at nothing. So you didn't even see it. They would often not even capitalize the asset. And so even in the last 10, 15 years, banks are actually bigger than everybody thinks, and banks finance the IMBs through the wholesale market.
Yep.
But do banks really want to get back into FHA lending? No. The regulators have told them avoid reputation risk, avoid op risk. And honestly, the IMBs are so much more efficient at dealing with things like servicing, and especially special servicing, that there is no way the banks can compete with them. That's the key thing. I think, I always hear our friends in Washington at the various agencies waxing eloquent about how the banks are going to come back. And I look at them and I say, no. First and foremost, the risk-adjusted return on a 1-to-4 family mortgage is not high enough to be worth their trouble, given all of the other attendant risks. At the minimum, if you want to be like a city, you originate the asset and you sell it. You have a flow agreement in place with Cenlar, off it goes. You don't even worry about that. And
they also tend to get in and out of the game when it's convenient.
Absolutely. But
And
you have banks that have been trying to get into warehouse. There's a whole list of them that have announced it.
Yeah.
Can you do it when Jamie Dimon's got 50, 60% market share? Well, you're going to bank the credits that Jamie doesn't want.
So there's let's pivot to tri-merge credit reports, and the NBA's.
You were in my column today.
I need to see. Did you send that to me?
I did.
I think you sent me yesterday's. You sent me yesterday's. I'm not sure.
No.
I've not looked at my email. I've been busy prepping for this huge moment.
I talked to many people.
Well, let's talk about it. I mean, I'm not sure if you've had the chance to read the blog by Mortgage Bankers Association President and CEO Bob Brooksmith, but he responded count for count, line by line, to the CHLA's opposition to their white paper on this idea of a single pool. Have you had a chance to see any of Bob's comments yet?
Oh, yeah. I asked him for his top 3 points. I put him in the column. I think, what he's saying is let's get the government out of this. And I totally agree with that. The issue I think you and CHLA have raised, which is a very relevant issue, is okay, fine. We can take 700 or 720 or 740 borrowers and do one pull, and we probably don't have an issue. We may have problems occasionally, but it's going to be very small. But if you do that with low FICO, low or high LTV borrowers, you're probably going to have problems. And this is why banks aren't in that market, by the way. It's exactly why. So I think there's 2 sides to this argument, but I also think that the Trump administration is looking for things that they can do to say that they are lowering the cost of mortgage lending. So my bet is that they're going to go with this at some point.
I still feel like it's problematic. It's concerning. I did this has not been shared with the public at the time of this recording, but it will be by the time we air this on Monday. I did an unbiased, and I want your opinion because I'm still reflecting on these numbers. So I asked our Encompass team to pull 10,000 random tri-merges from our system. They've already been pulled from previous customers and prospects to previous customers to reflect on tri-merge scores and how many fell above 700, how many, so on and so forth.
Mm-hmm.
So I'm pretty much seeing this for the first time. So of the 10,000 borrowers we pulled that got tri-merges, 55% of them had 3 scores above 700. That's good. We like that, right? Because that proves it out. 682 of them, so 6.8%, had 2 scores at 700, 1 below 700. And 724 of them, 7.25% of the 10,000, had 2 scores below 700 and 1 score above 700. So when I look at that, I look at a 15%-ish number of people that have just 2 scores or 1 score above 700. That's problematic to me. I mean, what did it take to crash the market during the great financial crisis? 15% of foreclosures. So like when you at first blush hear this number, which is real data, this is not manipulated in any way, that 7.24% out of 10,000 have 2 scores below 700. What is your initial reaction? Is that a problematic? Should there be other levers and guardrails now that you've heard those numbers?
Well, yes and no. We don't have the same market we had in 2008. In 2008, we had a market that was 60% private, a lot of fraud, not nearly any kind of consistent approach to documentation.
And not as much equity. Not as much equity,
right.
too.
I worked at Bear Stearns, so I'm allowed to say these things. But, today, what you're telling me, and I worked in the ratings business. I was head of research at Kroll Bond Ratings. The dispersion in FICO scores is not surprising. And the reason is that the different providers calculate them differently. Everybody thinks they're the same, but they're not. So this was one of the reasons why FICO, when they counterattacked against the 3 bureaus, they said, look, fine, we'll just go directly to lenders and give them our score, and they don't have to worry about the other 3. So if I'm running a lender, you know what I do with that dispersion that you just illustrated so nicely? I would take the lowest score. And by the way, that's what we do in ratings. Ratings always uses the lowest score. So
But
Moody's
that's
at a B.
counterintuitive to what the NBA is proposing. So I must be misunderstanding what will you do with
No,
that lower
no.
score? Would you say use
What
that low score?
they're saying is the high value, high quality borrowers don't need the same degree of rigor. And they're also saying that the lower quality borrowers more expensive to underwrite. You know, you and I discussed this. What if we miss something, right? And the truth of the matter is, even though we've rolled up this industry in the three big bureaus, they're still not the same. They
Yeah,
don't
well,
go and look
one
at their
thing
own
is,
files.
look, the dysfunctionality of these and inadequacies of these three bureaus, they force us to ensure that they continue to exist. How twisted is that? You know, the fact that it's so
Well,
convoluted that not
it's
everyone is doing the
monopoly
same thing.
economics.
Yeah.
they,
So
they,
Chris,
they, they
so
go to survival.
yeah, so one thing that Bob points out is that if FHFA goes through with this single pool idea, that it has not been, this is his words, word for word, we do not believe they would adopt a one report policy while holding lenders responsible for data that appears on one of the other two bureaus that the lender was not required to obtain. So he's saying we would insist on that approach, as any other policy would defeat the objective of delivering meaningful cost relief to borrowers. So it's kind of like this,
Ooh,
like,
ooh,
okay, I can't,
yeah.
it's almost akin to me like you need just one pay stub for a loan to close, and you got two, and you see that oh, this one pay stub here that I don't necessarily need, it's got some kind of alimony payment that the other one doesn't have. I'm just going to throw that I'm going to unsee that. So
Well,
when you
no,
hear
but
that, when you hear
he's
that,
saying
like, let
something
me
even more, Greg. He's
tell
saying
me.
that FHFA is going to have to give lenders a safe harbor against repurchase demands.
And that's what
If it
sticks out
turns
the
out,
most to me. Please give me your comments on this now that you've heard that.
I think that, for Bob to get what he wants is going to be extraordinary because, as you know, all of the lenders that we work with every day, right? Many of them like the government market because they know what the rules are. They know the rules aren't going to change day to day. Whereas in the FHFA world, depending on who's in the White House, the rules can change a lot. And that is particularly the case with repurchase demand. So if what Bob is saying is, I go to a one pull strategy, but FHFA has to give us all a safe harbor on things that were not in the pool that we chose. Okay, because that's my big worry for lenders like you. If you miss something, but you pulled one report, they shouldn't penalize you for it if they've told you that that's okay. You see?
Yeah,
That's
but
the
if we're insisting they look the other way, then we're acknowledging that there likely exists some problems. Otherwise, you wouldn't need that provision. So what kind of seeds
yeah.
could that be sowing for potentially another crash, or a lower bid on MSRs, or higher LLPAs? I mean, like you said, this administration has 3 more years in there. Who's to say that Democrats don't return and Rohit Chopra doesn't come back?
You got it. No, I totally agree with you on that. FHFA's market has always been risky because of that very quality. Look, ultimately, the issue is we shouldn't have 3 different sets of data for a consumer. The consumer should demand that all of the records that are in the public domain, which is what we're talking about here, should be available to everyone. And I don't know how you do that. You mash them all together and just have one big bureau. Because
I don't know, with technology the way it is today, AI should be able to somehow work with this and that to be able to produce a
yes.
score. And then there's
Oh no.
like, why don't we own, like they do in some European countries, why don't we own our own credit and permission it out? Then that solves the problem. Yeah, I'll still pay you Experian, Equifax, TransUnion, FICO, no problem. But I'm going to pay you one time for 90 days. And then I'm going to open up
Yeah.
that window to look at my credit to any lender I want. And then I'm going to shut that window. I'll get the updates necessary, but you're not going to run it 15 times to get me a quote.
But I like Bob's idea of making them compete because you know what'll happen? We'll end up with one. You really don't need
so here's my
3
question,
bureaus.
Chris. Here's my question. What prevents the other two that aren't getting pulled that often because maybe one of them turns out to be better than the other two or whatever. What prevents the price hikes from continuing? Or is the thought potentially that you back them into a corner where the NBA proves their point and now all of a sudden we have an antitrust thing on our hands and the DOJ may get involved?
Well, they certainly should, given the past behavior of the bureaus. But I think, Bob's instinct about competition is right. There's just operational issues here because when you're dealing with low FICO borrowers and you're also dealing with fraud, you have a lot of things that you have to be careful of in terms of the lender, taking responsibility for a loan. And, forget about the FHFA and Fannie and Freddie for a minute. Imagine you're selling that loan to a private investor. The private investor is going to make you sign reps and warranties that will make you buy that loan back if you miss something. So that forces you to do a tri-merge whether you want to or not.
Yeah.
That's
well,
that's the bottom
does
line.
how does this single versus tri help affordability? Do you see any way that this helps?
The
We're talking
dollars
about
are
borrowers
small.
700 and higher. So what's that do?
$150 for a tri-merge. I don't think that moves the needle very much when the cost is $11,000, $12,000. Does it help on the margin? Does it help lender profitability if I don't have to pay for the same thing over and over again? Yeah, it's not insignificant, but the problem is bigger than tri-merge. I just think in the current environment, given how pressed people feel in terms of not just affordability, but inflation generally, anything that a politician can do that is responsive to that attracts attention. That's why everything that Trump has considered when he's met with Pulte and our beloved Commerce Secretary has basically been on the demand side. There's not much they can do on the supply side in the short run.
What do you think about the Biden administration when it came to housing? You think they came up short?
Yeah, it was more of the same. They were not just trying to pump prime demand, but they were trying to use the enterprises for low-income lending, which makes no sense at all. Where do you take a low-income first-time borrower? To the FHA, because 99 times out of 100, they're going to get better execution. In my world of securities, we have suitability. A lot of lenders, and I'm sure some of them, won't allow their people to show a Fannie Freddie loan to a low-income borrower. There's no point. They're going to get worse execution. So that was the Biden administration. There are people in Washington, Greg, who think that Fannie and Freddie have a mission in terms of low-income borrowers. But the truth of the matter is they're set up for the middle class. That's what they do.
Well, but they were never supposed to be. They weren't put in place, as I understand it, to be cash cows and to make a ton of money. But I mean, that's the other thing is the
they should be
LLPAs,
utilities.
but the LLPAs, the G fees, that was all born out of the great financial crisis. Those were never supposed to be permanent, but now they've got these massive enterprise cash cows. That seems wrong to me. That hasn't reverted back to what it was supposed to be.
Those LLPAs that were put in place immediately after the crisis were meant to lock people in so they couldn't prepay their way out of the portfolio. That's how they protected Fannie and Freddie. Because remember, they were out of the game for years. Ginnie Mae was the only thing standing in that market after 2008. It wasn't until really the middle of the decade that the GSEs started to re-engage. You had Wells, you had a couple other big banks that were still in the market, but everybody else ran. As soon as Bank of America closed countrywide, they shut it down. One of the most extraordinary things I can remember in my career.
We're going to wrap this in a second. I know you have a very important dinner date, and I did not get an invitation, but maybe soon I will. Now that we're becoming best friends.
When you're in New York, man, you got to let me know. I'll bring you here. Mark Twain's favorite club.
I've not been there for too long, although it's very hard to avoid the pizza. So by the time I see you, I might be full because there's one on every stand. This fascinates me. Your dad was a speechwriter for Nixon and Reagan. Talk about what it was like to be the son of a dad that had that kind of responsibility, and what did you learn about it?
Well, our house in Washington was very interesting. We had people roaming in and out of the salon at all hours of the day and night, and people talked to one another. My mother, Joan, was the great entertainer in Washington. If you didn't get an invite to her Christmas party, there was something wrong with you. And I would sit on the stairs and listen while all these people drank and smoked and talked to one another. And it was a healthier environment. We got things done. I worked for Fritz Hollings as a very young man, and then I also worked for Jack Kemp. So I'm very much of the mind that we need to talk to one another. That's how we get things done. But unfortunately, Washington has become a very polarized place. But I feel very privileged. You know, my dad was a journalist. He worked for the Richmond News Leader and the Wall Street Journal, and then he went to Fortune. His big claim to fame was being the biographer of Joe Kennedy. He wrote some other books, but The Founding Father is one of the classics. And, you know, I feel very grateful.
Wow, that's a great recount of that. So how can people follow you? Because I would imagine a lot of people are like, I don't want this guy to stop talking, but of course we can't have you forever. So, I mean, you've got you've got a podcast. I think it's on
Yes.
YouTube called The Wrap with Chris Whalen. That's a weekly thing, right?
Yes, that is part of Julia LaRoche's show. In fact, I'm going to see her tonight. Julia has just, you know, very kindly included me in her rotation, but her audience likes our conversations. So
I see that
25,000
views, 50,000 views, 100,000 views. Hats off to both of you for that.
Well, we're trying to start something new. And, you know, I publish a blog called The Institutional Risk Analyst. I do focus a lot on housing. We just published our quarterly review of housing for our paying subscribers. And then I write a column for National Mortgage News, which is great fun. I try and keep it topical. And you were kind enough to reach out to me and poke me and say, hey, what about tri-merge? So that gave me an opportunity to talk to a number of people. And I
know.
Appreciate it.
Yeah, we're gonna.
And I'm active on X and LinkedIn under RC Whalen. We always put answers to questions up on X, and we have great fun. So,
well,
I
this was great.
You reaching out.
Of course, this was great fun. I hope to do it again. Enjoy your dinner, and hope to talk to you again soon, Chris.
Yes, sir. You all be well, and watch out for that snowstorm.